Breaking news, China has just raised its tariffs against the US from 84% to 125%.
China is digging in. Americans are waking up to a whole new escalation in the global trade war.
China's next move could dethrone Silicon Valley forever. Picture this, 2023, and China's tech engine is humming, fueled by $2.6 billion spent on ASML's lithography machines, the lifeblood of advanced chip production. These Dutch-made marvels were China's gateway to competing with Silicon Valley. But the United States, the self-appointed guardian of tech supremacy, saw a rival rising. Determined to slam the brakes, Washington orchestrated a ruthless strike. It strong-armed the Netherlands into revoking export licenses for ASML's deep ultraviolet DUV machines, critical for crafting chips smaller than 7 nanometers. The result? $15 billion in equipment inside China, scattered across factories from Shanghai to Shenzhen, was rendered useless. No updates, no repairs, no lifeline. It was a calculated betrayal, a technological guillotine dropped without warning. The US didn't stop there. Sanctions rained down on 140 Chinese companies, from chipmakers like SMIC to equipment firms like Nara Technology Group and Piotech. The goal was clear: strangle China's tech ambitions before it could challenge the West's dominance. Washington believed this would force Beijing to its knees, a humbled giant begging for scraps. But hubris blinds even the mightiest. China wasn't about to surrender. It was ready to fight back with a ferocity no one saw coming. The US sanctions were a high-risk power play, banking on China's dependence on Western tech. By weaponizing global supply chains, America exposed their fragility. When one link breaks, the whole chain shudders. This wasn't just a trade spat, it was the opening shot in a tech Cold War. The move underestimated China's resolve, igniting a conflict that now threatens to engulf economies worldwide. The question isn't just who wins, it's who survives the fallout. China didn't just absorb the blow, it turned pain into power. As early as 2022, Beijing had sniffed out the West's intentions and launched a silent revolution. The government funneled $47.5 billion into state-backed investment funds, targeting every link in the chip-making chain: design, wafer production, packaging, and lithography. This wasn't pocket change. It was a war chest to break free from foreign chokeholds. Money alone wasn't enough, though. China assembled an army of 50,000 engineers, pulling talent from Huawei, SMIC, and even luring expatriates back from Silicon Valley's elite. In a mere 3 years, they pulled off a miracle. A near fully localized chip supply chain, something analysts swore would take a decade. By 2025, Chinese factories hum with 50 to 60% domestic equipment, from etching tools to testing rigs. Local labs churn out chips and design software that rival the West's best. The real game changer? China sidestepped ASML's $200 million extreme ultraviolet EUV machines, once deemed essential for cutting-edge chips. A Shenzhen upstart, CCAR, cracked the code with its own DUV lithography tech, producing chips under 7 nanometers. Huawei's Mate 60 Pro, powered by a 7-nanometer chip made entirely with band tech, left the world slack-jawed. Now, SMIC is testing 5-nanometer chips, and eyeing 3 nanometers with AI-driven yield optimization, a leap that's rewriting the tech playbook. China's response is a masterstroke of defiance. Sanctions meant to cripple became a catalyst for innovation. By building a self-reliant tech ecosystem, Beijing isn't just surviving, it's redefining technological sovereignty. This shift challenges the West's stranglehold on chips and poses a stark question: what happens when China no longer needs Silicon Valley? The global tech hierarchy is crumbling, and Beijing is laying the foundation for a new order, one it intends to lead. When China slammed the door on ASML and TSMC, the shockwaves were merciless. ASML, Europe's tech crown jewel, watched its revenue crash 27% in Q4 2024 as China, once a top buyer, vanished from its ledger. TSMC, Taiwan's semiconductor titan, staggered as Beijing pivoted to domestic suppliers. These weren't mere financial hits. They were gut punches to the West's technological core. Meanwhile, China's SMIC soared, seizing 20% of the global chip market by 2025, a four-fold leap from 2020. China wasn't just playing defense, it was rewriting the scoreboard. The carnage spread beyond factories. China began dumping U.S. Treasury bonds at a dizzying pace, pulling billions out of tech giants like Apple, Nvidia, and Qualcomm. Wall Street trembled as mortgage rates spiked, tech stocks teetered, and retirement funds flickered on the edge of collapse. This wasn't a tantrum, it was a calculated escalation. The chip war had morphed into a financial siege, with China wielding its economic might like a sledgehammer. From London to New York, markets braced for impact, knowing the average citizen, homeowners, investors, workers, would feel the pain first. China's retaliation exposed a brutal reality. Global tech is a fragile web, and pulling one thread unravels it all. ASML and TSMC, caught between U.S. demands and Chinese profits, became collateral damage in a war they didn't start. China's bond dumping strategy turned the conflict into a currency war, where economic stability itself is a weapon. The West's reliance on interconnected markets is now its Achilles heel, and Beijing is exploiting it with surgical precision. This isn't about chips anymore. It's about who controls the arteries of global wealth. Enter Donald Trump, storming back in 2025 with a tariff crusade that set the world ablaze. His plan: slap 10% tariffs in February, 10% more in March, then a staggering 34% jump by April, with threats of 104% on Chinese goods. The math is brutal. A $20 toy balloons to $40, a $400 iPhone hits $800, and a car could cost an extra $12,000. Trump's pitch? Protect American jobs. The reality? A trade war that's strangling the global economy. Every price hike hits consumers where it hurts, from grocery aisles to gas pumps. China fired back without hesitation, imposing 34% tariffs on $143 billion of U.S. goods, from soybeans to tech components. Beijing upped the ante, restricting rare earth exports, elements like neodymium and dysprosium that power 90% of global EV batteries, military tech, and semiconductors. They also blacklisted 13 U.S. defense firms, adding to dozens already targeted. Europe, caught in the crossfire, wavered. EU Chief Ursula von der Leyen vowed counter tariffs on U.S. steel, rallying allies to resist. Days later, she buckled, offering zero tariff deals to dodge Trump's wrath. Canada, meanwhile, played hardball, threatening to redirect 4 million barrels of daily oil to Europe, risking 40-cent per gallon gas spikes in the U.S. Trump's tariffs are a reckless bet, aiming to revive U.S. manufacturing but alienating allies and spiking costs. China's rare earth chokehold is a masterstroke, a single move that could paralyze Western tech. Europe's flip-flopping reveals its weakness, while Canada's oil threat shows even neighbors can bite. This is economic warfare, where every tariff is a landmine. The global economy, built on trust, is fracturing, and consumers worldwide are left holding the bill. While the West reels, China is building an empire. Shenzhen, once a factory town, is now Dragon Valley, a tech colossus rivaling Silicon Valley. SMIC's breakthroughs in 5nm and 3nm chips have leapfrogged Intel and TSMC, powered by AI and quad patterning wizardry. YMTC's 232-layer NAND flash memory sets a global benchmark, outpacing U.S. rivals who can't keep up. China's semiconductor market share has doubled to 30% since 2020, fueled by $410 billion in R&D since 2022. This isn't evolution, it's a revolution. China's slashed Western imports by 50% in 2024, forging a self-sustaining tech ecosystem. From smartphones to electric cars, the chips driving your life are increasingly made in China. Huawei's Mate 60 Pro was just the start, a 7nm chip that laughed in the face of sanctions. Now, every industry feels the shift. Chinese factories churn out 50 to 60% domestic equipment, and local software rivals giants like Cadence and Synopsys. China isn't catching up. It's setting the pace, forcing the world to play by its rules. China's rise is a lesson in turning adversity into dominance. sanctions meant to hobble became a springboard for innovation. Dragon Valley is more than a place. It's a symbol of a world where power flows east. By prioritizing self-reliance, China has dismantled the West's tech monopoly, forcing a global rethink. The US, once the unchallenged big brother, now watches its little sibling become a juggernaut. The future isn't Silicon, it's Shenzhen. The tech war's true casualties aren't boardrooms, they're people like you. In the US, 62% of industrial workers dread layoffs as tariffs choke supply chains. Farmers, hammered by China's soybean and sorghum tariffs, watch markets collapse, with exports plummeting 50% in 2024. Consumers face a grim reality, prices soaring for everything from TVs to bread. The U.S. International Trade Commission warns tariffs could slash GDP by 0.5% and erase 500,000 jobs in export-driven industries. A looming $4.1 trillion corporate debt wall by 2026, paired with 9.6% yield junk bonds, signals a financial storm brewing. Globally, the pain spreads. Asian markets cratered after Trump's tariff threats, losing $1 trillion in a single night. Europe's indecision, swinging from defiance to capitulation, risks sidelining it entirely. Chinese capital, once a $46 billion lifeline for U.S. tech in 2016, has dwindled to $2.3 billion in 2024, starving projects from Ohio Robotics to California AI labs. This war isn't abstract, it's personal. Your savings, your job, your grocery bill, they're all collateral damage in a clash of titans. The human toll lays bare the war's stakes. Tariffs and sanctions sound like policy jargon, but they mean empty wallets, lost farms, and shuttered factories. China's capital exodus cripples U.S. innovation, while rising costs hit consumers hardest. The global economy, built on cooperation, is splintering, and ordinary people are caught in the rubble. This isn't just a power struggle, it's a fight over who pays the price for ambition. As the US-China trade war rages, Germany, Europe's industrial heart, is bleeding. The German Economic Institute, IW, warns that a full-blown trade war could slash Germany's GDP by over 1% by 2027, a devastating blow to an economy already shrinking for 2 years straight. Germany's export-driven model, once its strength, is now a crippling weakness. With 20% tariffs looming from the US and potential EU retaliation, German carmakers like Volkswagen and BMW face plummeting demand. Exports to the US, worth 150 billion euros annually, could crater by 14.9%, while trade with China might shrink 9.6% if Beijing's tariffs escalate. This isn't just about numbers. German factories are pausing production, hit by soaring energy costs and supply chain chaos. The IFO Institute predicts a third consecutive year of recession in 2025, with consumer confidence at its lowest since the early 2000s. Workers fear layoffs as orders dry up, and small businesses brace for insolvency. China's 125% tariffs on U.S. goods ripple across Europe, forcing Germany to pick sides in a fight it can't win. Align with Washington and lose Chinese markets. Defy Trump and face his wrath. Germany's caught in a vice, and the screws are tightening. Germany's plight reveals the trade war's brutal collateral damage. Exports, the lifeblood of its economy, are under siege from all fronts: U.S. tariffs, Chinese retaliation, and global uncertainty. The EU's talk of counter-tariffs risks escalating the conflict, but Germany's industrial giants can't afford a prolonged standoff. This is a cautionary tale of globalization's fragility. When superpowers clash, even mighty economies like Germany's can buckle. The longer this war drags on, the deeper the scars for workers and businesses alike. In a fleeting moment of reprieve, Trump announced a 90-day tariff pause on dozens of countries, sparing them from his 104% levy on Chinese goods. Markets surged. The S&P 500 soared 9.5% in a single day, its biggest leap since 2008. But don't be fooled. This pause is a mirage, offering no real relief. China doubled down, hiking tariffs on U.S. imports to 125%, signaling no surrender in this trade slugfest. The University of Michigan's Consumer Sentiment Index plunged to 50.8, its lowest since 1981, with Americans fearing 6.7% inflation, a four-decade high. Global recession fears are spiking. Goldman Sachs now pegs the U.S. recession odds at 45%, while J.P. Morgan warns of a 60% global downturn risk. Markets lost $6 trillion in days, and the dollar's wobbling as investors flee to gold, hitting record highs. French President Macron called the pause 90 days of uncertainty, a poison pill for businesses already battered by supply chain snags and soaring costs. From Tokyo to Brussels, leaders scramble for deals, but trust is evaporating. With China vowing further retaliation and Trump's team shrugging off turmoil, the world's on a knife's edge. Trump's pause was a tactical feint, not a truce. The trade war's too entrenched for quick fixes, with China's tit-for-tat tariffs proving it's ready to bleed to win. The market's relief rally masks deeper wounds. Inflation's back, and confidence is shot. Consumers, businesses, and allies face a grim reality. Uncertainty is the new normal. This isn't just a policy spat. It's a global power struggle, and no one escapes unscathed. The clock's ticking on those 90 days, and what comes next could tip the world into chaos or force a reckoning. The tech war is redrawing the map of power. China's bold move has shaken the world, but the story isn't over. Your smartphone, your car, your future, they're all tied to this battle. Stay informed, because in a world where chips are king, knowledge is power. Subscribe, share, and let's keep digging into the truth.